Hello and welcome to This Week in Markets. If you thought last week's tug of war was intense, this week Dalal Street experienced a total late-stage collapse. The week actually kicked off on a euphoric note with the Sensex surging 1,000 points on Monday, but a brutal final hour sell-off on Friday wiped out those gains and sent shockwaves through the market. By Friday's closing bell, the Sensex plummeted over 1,092 points to finish at 74,775, while the Nifty cracked the key 23,600 threshold, shedding 359 points to settle at 23,547. That early Monday rally was completely driven by the West Asia narrative. Reports indicated that the US and Iran reached a draft agreement to extend their ceasefire by 60 days, though we are still waiting a final approval from US President Donald Trump. This easing of geopolitical tensions immediately cooled off global energy prices. Brent crude took a dive, softening from $97 a barrel to settle in the $90 to $91 range, providing temporary relief to inflation-wary investors. But domestic realities quickly caught up. A massive banking liquidity squeeze is unfolding. According to brokerage data, the average daily banking system liquidity has shrunk to just roughly 50,000 crore rupees in May, down from around rupees 3 lakh crore in April. This has forced the cost of certificates of deposits up by 60 to 70 basis points, pushing several PSU banks to launch special high-interest deposit schemes just to attract cash. Globally, inflation fears are also back in the driver's seat. US inflation unexpectedly accelerated to a 3-year high of 3.8% in April, up from 3.5% in March. Coming to fund flows, early in the week things were relatively stable. On Monday, both camps were actually net buyers, with foreign institutional investors adding about 821 crore rupees and domestic institutional investors buying over 3,856 crore rupees. While FIIs turned into net sellers on Tuesday and Wednesday, shedding roughly 3,450 crore rupees combined, DIIs continue to heavily support the market, adding over 5,100 crore rupees in those 2 days. But then came Friday. The highly anticipated MSCI May rebalancing triggered an absolute historic exit, as global passive funds executed mandatory index adjustments right before the final bell. Institutional selling hit extreme levels. On Friday alone, FIIs offloaded a staggering 21,105 crore rupees in the cash segment, while domestic institutional investors fought back with a massive record-breaking net purchase of 16,764 crore rupees on the same day. The sheer weight of foreign cash exit was too much to bear. When we look at the sectoral scoreboard, the divergence was wild. BSE Power and Capital Goods were the undisputed stars, surging 3.7% and 3.2% respectively. On the flip side, FMCG and oil faced heavy selling, dropping 1.5% and 1.4%. In terms of individual stock moves, Tata Motors PV led the Nifty gainers with a massive 8.4% jump, followed closely by Adani Enterprises up 8.1%. On the losing end, ONGC shed a painful 8.5%, while Max Healthcare and ITC dropped 5.7% and 4.9%. It was also a week of blockbuster corporate moves. Wockhardt shares went absolute gangbusters, surging 28% this week alone. This came after the CDSCO granted authorization to import and market Zynyj, its indigenously developed first-in-class breakthrough antibiotic in India. Coal India's OFS. The government launched a massive 5,000 crore rupees offer for sale to divest up to a 2% stake. Non-retail investors swarmed the issue on day one, oversubscribing their portion by more than 2 times and pushing the indicative cutoff price up to 417.62 rupees. Emirates NBD Bank has officially triggered the next phase of its massive takeover of RBL Bank. Following their initial controlling stake agreement, they launched the SEBI-mandated open offer to acquire up to an additional 26% from public shareholders. The offer targets up to 41.55 crore shares at 282.38 rupees each, making this regulatory leg worth an eye-watering 11,735 crore rupees. But here is a twist. With RBL Bank shares currently trading near 347 rupees a piece, this massive offer is effectively dead on arrival. No rational investor is going to sell at a steep discount, meaning Emirates NBD gets to check the regulatory box with SEBI without actually having to spend that extra cash, while retail investors get to keep riding the stock's upward momentum. As we look into next week, the technical picture has drastically shifted. Friday's late sell-off injected fresh uncertainty, and on the monthly chart, Nifty has formed a bearish candle with shadows on either side reflecting deep indecisiveness among traders. Immediate support has now dropped to 23,300 to 23,250 zone. A breach below that could open the trapdoor straight down to the psychologically critical 23,000 mark. On the upside, any recovery attempt will face stiff resistance around the 20-day EMA zone of 23,750 to 23,800. As the Q4 earnings season has officially come to an end, domestically all eyes will be on the RBI's interest rate decision and India's Q4 GDP growth numbers, both scheduled for Friday, June 5th. We'll also be tracking the May auto sales figures, April IIP, and manufacturing PMI data dropping earlier in the week. On the global front, watch out for the US and China PMI prints to gauge the temperature of global economy. That's all from our side for the week. Thank you for watching. We'll see you next time. Don't forget to follow Fortune India to keep track of the latest updates from the business world.